Good evening, ladies and gentlemen. Before we get this show on the road, I would like to take care of some housekeeping matters. You are kindly requested to keep your phone on silence for the duration of the session. Please remember to collect a copy of the Monetary Policy Review as you exit this venue at the end of the session. The importance of the Monetary Policy Review cannot be overemphasized. The Monetary Policy Review is a must-read publication which is aimed at broadening an understanding of the objectives as well as conduct of monetary policy. You are also kindly requested to complete feedback forms which are in your notebooks and place them at the same place where you're going to pick up a copy of the Monetary Policy Review. I would like to respectfully beg your indulgence as I briefly highlight procedures to be followed in the unlikely event that we have to evacuate this venue. There are 3 primary exits next to the lifts marked as Exit B, on the southeastern side of the general reception area under the glass dome marked as Exit A, on the northern side down the stairs past the conference and syndicate rooms marked as Exit C. Evacuations will be initiated by the activation of a siren and/or announcement over the public address system. Conference center personnel will take charge of and direct all building evacuations. Please don't panic during an evacuation, remain calm, and follow the guidance of the conference center or protection services personnel. Follow the evacuation officials to the designated assembly points. I think that's it as far as housekeeping is concerned. Now that we've got housekeeping out of the way, I would like to formally extend a warm welcome to all our guests and stakeholders. The effort you made to be here tonight is not something that we take lightly. The bank is grateful and appreciates the opportunity to interact directly with you in an effort to develop a better understanding of monetary policy. Tonight, ladies and gentlemen, you are being hosted by the oldest central bank in the African continent. The SARB was established more than 97 years ago. Since its establishment in 1921, we have had. It is my pleasure and privilege to call upon the 10th Governor of the South African Reserve Bank and the Chairperson of the Monetary Policy Committee to come and pass some remarks. Governor,
Thank you very much, Nimrod. I understand that there are also a number of excellencies who have joined us today. Welcome. Before I hand over to Chris Lovald, who will do the presentation, on the panel you have got members of the MPC, Daniel Minele, Franco Group, Kuben Naidu, Fundi Chasivana, and Rashad Kasim. This MPR is taking place in the context where global growth is less synchronized than what we saw at the beginning of the year. The slowdown in economic growth is in the main driven by emerging markets, whilst the developed markets have been growing stronger than we had seen in the past. And this has prompted central banks in the advanced economies to begin the process of monetary policy normalization. Others faster than the other, the US Fed moving faster than the European Central Bank and the Bank of England and the Bank of Japan. As this process of monetary policy normalization evolves, you are then also seeing tightening global financing conditions. And as global financing conditions tighten, as we have expected, capital is starting to flow from emerging market economies into the developed world, as we saw the yields in the US rise and the US yield curve rise, and thus making US treasuries more attractive than they had been in the past. And as such, the differential that that investors had been seeking between the advanced economies and the emerging markets, where the emerging market economies were offering higher yields, is narrowing. And as such, you are starting to see capital flows back to the advanced economies. In this process, a number of risks do emerge, and amongst those risks are rising indebtedness or in the non-bank financial sector. And what we had seen globally had been that the corporate sector had, in the emerging market economies, had borrowed in the main in dollars. And investors are beginning to have to distinguish and look at where the vulnerabilities in the global financial system actually lie. But where does South Africa fit within this environment? When the US indicated that they would be looking at normalizing monetary policy in 2013, which is what people commonly refer to as the taper tantrum, we had a situation where South African inflation was elevated, and in some of the months even outside of the target. We had a situation where we ran twin deficits in double digits combined. And so we look at where the emerging market universe is now, and we say, how does South Africa compare between now and then? And when we look at those indicators, we can tell that the twin deficits of South Africa are now less than what they were in 2013. The combined twin deficits in 2013 were above 10% of GDP. Today, they are closer, just above 7% of GDP. So we're less vulnerable than we were then. On the inflation front, we had managed to have inflation within the inflation target range for a protracted period of time now. But more importantly, it's been that inflation is closer to the midpoint. Well, that is yesterday's inflation and today's inflation. What matters for monetary policy is what inflation is going to be in the future. And the presentation that is going to be made will also present the forecasts from the SARB's point of view with respect to inflation. And you will see that although it is rising, it is still within the inflation target range. Of particular concern for us had been that inflation expectations have remained sticky at the upper end of the inflation targeting range. The interesting thing about South Africa had been that whereas other emerging markets also binged on foreign currency denominated debt, you have had a fiscal, in the form of the national treasury, which had continued to borrow modestly in foreign currency. So whereas you might see that South Africa's foreign debt has risen over this period, what differentiates South Africa from most emerging markets is that the bulk of South Africa's foreign debt is actually denominated in rands rather than in foreign currency. That's because foreigners have bought South African financial assets, and that makes us less vulnerable than we were before. But that said, that does not mean that with capital outflows we would not be affected. We had previously stated that as monetary policy normalizes in the developed world, there will be a repricing of financial assets in emerging markets, and that this repricing of financial assets will take place firstly through the pricing mechanisms, as you would have seen, but whether it is rising bond yields or is lower stock market, but importantly for a small open economy like South Africa, it will reflect itself through a realignment of exchange rates. And exchange rates did realign globally, and in that process, it was just important that for a country like South Africa, which had pursued a policy of a floating exchange rate, that we continue to see the adjustment in the exchange rate as necessary to be a shock absorber against the shocks that emerging markets actually had experienced. Of course, with that shock, other things play in, and the central bank will get concerned if the realignment or the depreciation of the currency would fit itself into second-round effects and lead to rising inflation, and that is what monetary policy should respond to rather than the first-round effects of that depreciation. That's the snapshot of what I thought that I would say in introducing the presenter, Chris Lowald, who has got a nice bioscope to show you. The pictures speak more than the words that I would have expressed. Chris?
Thank you, everyone. Good evening. Thank you all for coming. Let me also thank my team who put together the MPR. They worked very hard on it. They're all sitting here in the front row, and you're welcome to approach them after the presentation to chat with them about things. Sorry, Daniel's distracting me here. So as usual, I'm going to work through a presentation trying to show you some of what the governor was talking about in pictures. Tells a story about monetary policy over the last few months and going forward. I have to just get my technology working here. Okay. So what's the October review about? Well, it's about volatility and fundamentals. That's what we've titled it. And in particular, trying to look through that volatility and keeping policy focused on the fundamentals. As the governor said, this period of strong synchronized global growth that we've seen over the last couple of years is starting to fade, and there are a variety of reasons for why that's happening. We'll talk a bit about. And this is happening in a context in which South Africa's growth rate remains weak, and our macroeconomic imbalances are somewhat smaller than they have been, which is certainly a good sign. But we worry quite a bit about the need for a bit further adjustment in those imbalances in the global context that we're seeing. Lower inflation that we've had over the past year is not expected to persist. We're very thankful that it's come down as low as it has, and obviously we'd like to see this persist, but it's not what's scheduled in our forecast and not built into expectations going forward, which is something I will try to show you. So global growth moderating, first part of our global story. This is just global, trade-weighted global growth, and you can see, let's see if I can get this thing going here. Yeah, there we go. This is the blue. You can see that in the last 2 years, we've actually had quite a nice pickup from the bottoming of the cycle. This is post the global financial crisis. We had a bottoming of the global growth cycle. We'd have this very nice pickup here, and this is what all the past year's numbers have looked like. And here you've got this dotted line, which just shows you a very long-term average. So what's expected is an easing of those growth numbers down to the shaded bits. But it's still quite a bit higher than the long-term average, and obviously that's kind of a positive thing. But you will have seen in the IMF's recent meetings that there's a lot of concern being expressed about the risks to this coming down being a lot steeper, and there's been lots of discussion about why that might be the case. A variety of risks going on out there. One of the risks is that growth has become less synchronized, and so economies growing out there are not supporting each other as much as they have been in the past. The graph on the left-hand side shows you this. It shows you the proportion of the 50 largest countries with growth that is accelerating. And you can again see how synchronized this pickup was. You had over almost 80% of the largest countries in the world accelerating quite nicely, and then going forward, we've got this tailing down quite quickly. The growth is less synchronized in another sense because, of course, it's been driven primarily by the US economy as opposed to the euro area and Japan. Here, you've got both, all three areas kind of growing pretty well, but the pickup, the acceleration in growth has been stronger in the US than the others. And as the growth tails off, you can see that this deceleration is also quite steep, Japan as well. So there's quite a bit of divergence in the ways in which advanced economies are growing. Inflation has been rising back to the target. That's part of the growth story, and it's part of normalization of inflation generally. It's normalized much quicker, or inflation is normalized much quicker in the US, as you can see on the left-hand side. We're showing you headline, which is the dark blue, and then the core number is that dotted line there. The euro area is lagging a little bit behind, but not by much. You can see inflation has picked up quite sharply in the latter part of 2018. Japan also, their quantitative easing program has actually started to pay some dividends. There's some stronger growth rates in there as well. And so throughout the advanced economies, the G3, you can see that inflation rates are starting to come back strongly, more strongly than they have. And that, of course, is prompting this interest rate normalization that the governor mentioned earlier. You've got the blue is the G3, the shaded blue bit is the G3 average, but this is the US, and you can see that they have normalized quite aggressively since 2016 by 200 basis points over this period, and it's expected to go up above 300 basis points by 2020. The euro area is also expected to start picking up, but hasn't yet, and is obviously the pace of that is aligned with their lagged inflation rate. But there, of course, there is risk to these outlooks. Inflation rate starts to pick up more strongly than is expected, then we can certainly expect to see that these policy rates start to pick up quicker. So what does that do to the yield curves out there? This is a picture on the left of the US yield curves, Treasury running from October 2017, that's the lower line there, up to September 2018. And you can see there's been quite a steep pickup in those yields in the short end, but also in the long end, middle part of the curve here, and a bit on the long end as well. That's generated, as those interest rates have risen, that's generated a rise in the dollar, and you can see that very strongly here. It comes from about 2015 on, a bit of a dip in the middle, early 2018, and then much, much stronger in the second part of 2018. Here's a view of how that's impacted on capital outflows. Again, really good capital. Really good capital inflows in 2016 into emerging markets. This excludes China. 2017 was even stronger, but you can see what's happened in 2018. Positive for much of the year, but May is the turning point, and things start to become much more negative from that point forward. So what does the sell-off look like in terms of currencies? This is a range of emerging markets running from Mexico up at the top to Argentina at the bottom. The bottom three, in fact, are Argentina, Turkey, and there's South Africa. This is the EM average. It's at about 11%. So that's the extent of the depreciation in currencies that have occurred since May year to date against the US dollar. So we tried to pull apart a bit of why this is happening, and we always like to look at what's happening with macroeconomic fundamentals as the best explanation for these kinds of trend shifts in financial markets. These two graphs try to tell a bit of a story about one part of the macroeconomic fundamentals that obviously concern us a lot, and that's inflation performance. So the graph on the left is showing you how inflation forecasts for 2019 have fared compared to the target ranges of emerging market economies. And what I'm just trying to show you here is how you've got, here's South Africa here, you've got these big outliers, Turkey and Argentina. They are way outside of their target ranges. Even the high Argentine target range, they are expected to miss by quite a lot. The graph on the right shows you another kind of version of this, of the same thing. It just shows you the inflation forecast revisions from the WEO, the IMF's WEO, from October relative to April. And again, you can see there are particular economies where these inflation forecast revisions have been very large. And we would posit to you that one of the main differences here is that their monetary policies are quite differently constructed and differently anchored, with the ones on the right having much more weakly anchored expectations. The ones on the left, which include South Africa, have much better anchored inflation expectations. And you can see that those inflation revisions for those economies have been a lot lower. That's not the only explanation for what's going on here, but it's certainly one of them. Macro fundamentals extend beyond inflation, of course. I'm showing you here on the left the twin balances. So this is your fiscal account plus your current account for a range of countries. And again, you can see that economies that have quite high combinations of those twin deficits sit on the right-hand side. That's Argentina, India, Brazil, Turkey, South Africa, Colombia, Romania. And you can see that for quite a wide range of emerging market economies, these twin deficits remain quite large. As a percentage of GDP, Argentina, you're looking at close to 10%, it's about 8, and then down 7, 7, 6, 5. So these are substantial deficits. If we plot this against currency depreciation, you can see what you get on the right-hand side, and you've got Turkey and Argentina down here. So this axis shows you year-to-date currency depreciation. Argentina is sitting at about 50% against the size of the twin balances, and you've got a pretty nice trend line there, regression line showing you how these things stack up. The smaller your twin balances, your twin deficits, the less likely you are to get hit by currency sell-offs. So where does that leave South Africa? Well, we'd like to say that the South Africa's macro adjustment is still underway. We've seen, particularly the last 2 years, a nice tailing off of the current account deficit to numbers that are much, much better behaved. Part of that is driven a little bit by the fiscal account. I'm going to come back to these numbers. But unfortunately, South Africa's fiscal account remains relatively high. Those accumulated deficits, so the fiscal accounts building up in the current account and the public debt, have driven up South Africa's debt service costs, and that has contributed to a current account deficit that is quite a bit higher than we would expect at this stage of the cycle. So when I say there's still a bit of adjustment to go, that's what I mean by it. Now, part of the difficulty with the adjustment we had seen is that a lot of it's driven by the private sector and not by government. And this graph tries to show you the current account against net lending and borrowing. So you've got the household and firms' behavior is the blue. They were net borrowers in this period from 2012 up to 2015, and then they swung quite sharply towards net savers by 2017. The red shows you general government. So this is the cost to the current account deficit of the fiscal deficits over time. Now, why does it matter? Well, it matters to help explain, in part, not the whole story, why growth has been quite weak over this period running since 2016. So we've had a recovery since the bottoming out of the global growth cycle in 2016. South Africa has participated in that, but it has not been a very strong recovery. And in particular, in 2017 and 2018, of course, we had some quite bad growth outcomes indeed. This graph shows you gross fixed capital formation, and you can see how it's picked up quite nicely until about 2016. And then as the current account balance starts to be compressed, it feeds through into less investment by the private sector in particular. The public sector investment growth rates also come off quite strongly. That has fed through into confidence. You will all be quite familiar with these numbers, but this is just showing you business confidence over a very long time frame. This very nice period when business confidence was very strong runs from about 1998 through to the global financial crisis. And we saw a nice recovery to it, but then this tailing off again over this quite extended period. And of course, we go below the average line in 2016, 2017. Part of the context here is institutional weakness. So why did growth tail off so much sharply in 2017 and 2018, early part of 2018? Well, part of it comes from something that you're familiar with, which is just our perceptions of what's going on out there, corruption, government instability, as measured by the World Economic Forum Executive Opinion Survey, gives us some insight into how this looks. It was high, rose in this period, but was relatively stable for a long time. There was no real sense of government instability, but then it started to feed through into the latter part of the period. So what does this all add up to? Well, part of it is low investment implies that our potential growth rate is low, and this is our model, the way we estimate it. I'm showing you here how South Africa fares relative to the rest of the world, and this is a pretty unhappy picture. You can see that most of the rest of the world has picked up in the wake of the financial crisis. A lot of that blue line is other emerging markets that came roaring back quite nicely in this period. But South Africa started to really decline in this period. There was a lot going on. There were electricity shortages and other factors driving into these numbers. But at the end of the day, it ends up with a potential growth rate, again, back in this 2016 to 2018 period, that is very low and stubbornly staying there. Having said that, the 2018 recession was still a surprise. So even though we expected growth to be low, and if you looked at the MPC statements, they will all tell you that the risk was to downside of growth, we still generated some pretty bad numbers. We can talk about these numbers a bit later, but there's various things going on in here, including a very large drop-off in the agricultural sector after the drought. So you have the boom in the sector and then a tailing off of that. But other parts of the economy were very weak in these 2 quarters of 2018 as well. Demand, not surprisingly, remains looking quite weak. On the left, I'm showing you how manufacturers respond when you ask them if demand is a constraint, and many of them say yes. And you can see this number tailed off. It was quite low in about 2013, 2014. So that's when the economy's growth rate was peaking in the wake of the global financial crisis. We bounced back quite nicely. But as the economy started to weaken, coming out of the taper tantrum period and through 2016, the bottom of the global cycle, our numbers continued to move in the wrong kind of direction. And that's reflected again in our output gap. So again, here's the global financial crisis. We picked up quite well. And then around 2014, we kind of peaked. And the output gap starts to expand again from that period forward. So in our model, closing the output gap gets us somewhere. It gets us from current growth rates up to about 2% in 2020, but it doesn't get us much higher than that. And this is really where the potential growth rate being low starts to bite with policy and act as a policy constraint on the economy. So we don't expect that growth rate to pick up very strongly. Here's the March number in blue and September the red. So those 2 quarters that underperformed and came out as a bit of a surprise have pushed down this number way down here. And so we're starting the forecast from that stage going forward. Inflation has been close to the midpoint recently. For the year to date, it's averaged exactly 4.5%. It's picked up to 4.9%, as you will have seen over the last 2 months, so it's well within the target range, but it's around the middle point of it. So we've got here underlying inflation, that's the blue and then the red is the targeted headline CPI. Short-term disinflationary shocks have helped get those inflation rates down, but they retain, they're intrinsically have their own sort of risks attached to them. You can see here on the right-hand side what's driven down those inflation rates. So a big chunk is core goods, and that is driven largely by the exchange rate appreciation that we saw in the period running from the late 2017 into May 2018. Another chunk is services, which will also include this owner's equivalent rent that's come out quite a lot lower than expected. And a big chunk remains this food inflation, which has consistently come out lower than we expected, except for last month where it caught us on the upside. What's always very hard to forecast is the turning points in all of these numbers. And we had expected food to start accelerating more strongly. Core goods is about where we expected it, and services has underperformed. So the inflation rate on a monthly basis come out a bit weaker than we had expected over the last couple of months, and there shows you why. Again, here's another view of what I was just talking about with those forecasts coming out quite well. Let's look at the headline. You can see this goes from the January meeting up to the September meeting, and you can see that these inflation rates for 2018, 2019, and 2020 even were reasonably well behaved. And then things started to change by that July meeting quite strongly, and our inflation forecast started to turn. The exchange rate has yet again become a source of pressure. So I mentioned just now that core goods inflation has underperformed below expected, in large part because the exchange rate strengthened. You can see that coming out here. So this blue line coming down shows you how the exchange rate strengthened out of 2017 into the beginning of 2018 and then depreciated. So here's where we start the new forecast for September, the red, and you get this very strong depreciation going forward. And that generates for our forecast quite a lot of inflationary pressure going forward. So one of the causes for that worsening in the inflation forecast. Petrol also is playing a pretty big role in here. You can see just how from between March and September, the blue and the red, how our oil price forecasts have changed quite substantially. That's $10 a barrel. Here you see it in Rand terms, how the petrol price from March has moved up from this quite low 15 Rand to the dollar, well up to 1740. So it's gone up quite strongly. So that's oil prices rising and the exchange rate depreciating. Inflation expectations have come down quite nicely. We've been talking about that for a while, but they haven't come down enough. And this graph, I think, shows you this quite well. They are sticky, and they're sticky up at around 5.5%, which is well above the midpoint of the inflation target range, and that's across all maturities, as you can see there. Wage increases continue to remain higher than we would like to see, and in particular higher than productivity gains, which generates the inflationary impulse to the economy. The graph on the left shows you the real unit labor cost growth greater than zero, and it's quite substantial over the forecast period running from March 2019 through to 2020. When we convert that into a driver of inflation, try to calculate how much that actually adds to the inflationary impulse. This is 4.5%, so this is your inflation target here, and the direct unit labor cost contribution is reasonably substantial. It's a common feature, of course, of the South African economy and continues to present a problem for the inflation rate. So where does this all mean for policy? Well, it means that the repo is rising in nominal terms. This is what our latest forecast shows. But the key settings on the policy rate are really about the real repo and the gap to neutral. So when you think about what's policy doing to the economy, doing to the inflation rate. We want to talk about it in these terms. This graph shows you what that neutral real interest rate looks like. That's the black line, black dotted line against the real repo and the trajectory for that. When the inflation rate collapsed earlier this year, you had a bit of a jump in the real repo, so that's just your nominal policy rate minus the inflation rate and gives you your real interest rate. But you can see over a very long period of time, basically since the global financial crisis, that real repo rate has been well below our estimate of neutral, supporting the economy in particular in the wake of the global financial crisis. And then policy from 2014 has started to reduce the amount of accommodation going into the economy over this period. With the inflation rate coming down again, you've got another quite strong real impulse to that. And over our forecast, you can see that the real repo rate only starts to hit the neutral rate quite late in the forecast period. Making the point a different way, the real repo gap remains there, and it's quite expansionary. This graph shows you how that real repo gap has evolved over time for recent meetings, so in this period. And as inflation starts to pick up here, it drives down that real repo rate even more. There's not much evidence of demand pressures at the same time. We're trying to show you here one thing really. It's just to make the point that over a long period of time, demand pressures haven't been a strong feature of the monetary policy consideration. One way I can show you this is to look at the old method we used around 2013 for estimating the output gap. There was only one really brief period between 2004 and 2008 when the output gap was actually positive, which would, all else equal, if you stripped out every other consideration, monetary policy suggested much higher interest rates. The rest of the period, it's been quite negative. Our latest method expands the period of time under which the output gap was positive, and you get a bit of positive right there. But since the global financial crisis, it's still been negative. When we look at how many times MPC meetings have met and experienced a positive output gap, under the latest method, it's more, but it's not a lot. It's about 40% of the time. So 60% of all of our MPC meetings are faced with an output gap that is negative. So nearing conclusion here. So why doesn't inflation reach 4.5%? Well, part of the problem is the expectations that I showed you earlier remain very sticky and much higher than we would like them to see. Policy effectiveness when it's high, should see a much more responsive change in expectations than we have tended to see. And you can see just from this graph just how sticky these things have been. Obviously, this again is the global financial crisis period, very large rand depreciation, and so our expectations of surveyed expectations pushed the inflation rate up quite high. And then it's come down to this kind of 6.5%, 7.5% level for quite a long time. This, the blue line is the model consistent expectations, so we use a kind of blend of forward-looking and backward-looking expectations as a variable in the model outcome. So let me conclude. Global conditions are certainly less favorable. It's hard to call them adverse. The global growth rate remains quite high. Inflation globally remains relatively low. But obviously, it is less favorable in the sense that if our macro fundamentals are moving in the wrong direction, it's easy to get caught out as U.S. interest rates normalize. Potential growth remains a policy constraint. I tried to illustrate that. And the exchange rate and oil in our current forecasts, or recent forecasts, are adding quite a lot to the inflationary pressure that's coming through. Our projected nominal rates are higher, but all things said, real rates remain below neutral rate and relatively supportive of the economy's adjustment path. Thank you very much.
Thank you very much, Chris. I forgot to indicate when I called Chris that at the end of his presentation, there will be an opportunity to ask questions. So I now open the floor for questions. And as usual, please identify yourself and the institution that you come from. Was that the presentation that clear? Oh. Yanni.
Thank you, Governor. My name is Yanni Rousseau from the University of the Witwatersrand. I have two questions on VBS Bank. The first question is, at the time that VBS Bank was placed under curatorship by the Reserve Bank, there was a lot of criticism from many organizations, even political parties, many people, etc. I would like to know whether any of them tendered an apology to the Reserve Bank after the Great Bank Heist report was indeed published and it became clear that the Reserve Bank took the right decision in terms of curatorship. My second question in respect of VBS Bank is whether we've reached the point now in South Africa where it's no longer sufficient to have one firm of external auditors for every bank, but that we should have two firms of external auditors for every bank, irrespective of the higher costs, as VBS Bank has shown us that the audit profession is really not up to scratch. Thank you, Governor.
Thank you, Yanni. We will take five questions at a time. Azar and the two hands at the back, which are, my eyesight is not as good as it used to be.
Azar Jamin, Chief Economist, Econometrics. Governor, to what extent are the fiscal parameters actually modeled in your QPM? In other words, if you, would you have received a shock with the MTBPS that would have, in a sense, altered the forecasts of the QPM at all?
Thank you. There are two hands at the back. Okay, let's start there.
Thank you very much, Governor. Kandan Msibi from NUMSA Investment. The Reserve Bank, in terms of the presentation, there's three key concerns. That's inflation, balance of payment, and growth. Right? Now, my question relates to the posture and the position of the Reserve Bank in the economy, that you tend to operate as a commentator of events past as opposed to an influencer of whatever is driving the variables that you actually want to see becoming positive in the economy. In as far as inflation is concerned, we all know that our economy is full of cartels in a number of its sectors. Right? Shouldn't the Reserve Bank be working with the State South Africa and the Competitions Commission to deal with the cartels and the structure of the economy so that the inflation, which is largely driven by the activities of the cartels, can actually be contained? Secondly, on the issue of the balance of payment, we import a lot of fuel as opposed to oil. So we have a less refinery capacity in the country. And as long as we are exposed to a number of commodities, you look at the fact that a number of pharmaceutical companies actually divested out of South Africa and are importing their products. We're not manufacturing locally. So without the level of intensification of local manufacturing, we are exposed to a balance of payment that is not in our favor. The third one is about growth, that the Reserve Bank does not seem to play an active role in ensuring that there is a growth in the economy. And then I'd like to hear more as to whether there are opportunities for the Reserve Bank to begin to study the constraints to growth in the economy. And in particular, the fact that the majority of the black South Africans are not participating actively in the economy, that there's no ways that you can have an economy that can actually grow when a significant part of the population is not a party to that economy. Thank you.
That is quite a mouthful. Yes, sir.
Yeah, thank you, Governor. My name is Isaac Mahlakwane from COSATU. I'm also a lecturer. Depend which one do you take. I've got three simple questions, but I think that the former speaker took some of them, but let me put them differently. The first one will be around the current stimulus package by our current president and the recent 290 billion investment that were pledged at the investment summit. Is it now that the Reserve Bank can try to also play part in terms of, because I'm of the view that investment spending is very much minimum compared to consumption confidence. Because I think even if you get employed, but if now you're in the midst of high prices, it might be a problem for someone to enjoy his working thing. So I think what I'm trying to say is it a point whereby we can try and reduce a little bit of a repo rate so that we can try and stimulate consumer spending? The second one will be, Governor, there's been a view around the mandate of the Reserve Bank. Understand probably might be the answer, we might be having the answer. You know, where I'm coming from is we from the job summit, where one of the suggestions was why the Reserve Bank doesn't fund the DFIs directly so that they cannot compete at the commercial space with the high interest rate or market interest rate. Why don't we fund them directly so that they can stimulate growth and create jobs? The last question, Governor, is around the weaker rand. We're having a weaker rand and it's not competitive in the emerging market and all the globally. Is there any point where Reserve Bank can apply the open market policy where they can actually sell some of the bonds so that we can buy back the dollar that we have lost in a couple of years ago? Thank you very much.
The dollars we lost a couple of years ago. I don't remember us losing dollars. But you said a couple of years ago.
No, what I'm trying to say, Governor, is remember, even at the statement you said we had the capital outflow whereby money was leaving South Africa. And some of those things are the reason why now we're having a weaker rand. So why don't we actually buy back some of those things back to South Africa by selling the bonds?
Okay. Okay. DG Naidu, looks like you're going to be the last person to answer because I want the VBS thing to be dealt with last. Let me take the easy questions and then I will leave the more difficult questions for the members of the panel. The fiscal parameters, how we deal with them in the QPM, we do not deal with them in the QPM. We actually take the output of the core model. That is how we deal with the fiscal parameters. The fiscal block in the modeling becomes tricky. It is not a straightforward thing because it comes via this and via that and via that. The key thing to watch is when there is an emergence of fiscal dominance. We have not seen evidence of fiscal dominance in South Africa. And the reason I am saying that is because it links to the question that Isaac had raised about why the Reserve Bank does not fund directly DFIs. DFIs are an extension of the budget. And so once the central bank gets into the funding of the DFIs, the central bank is involved in deficit financing, a dangerous, dangerous concoction. You do not even want to get there because then you suck the central bank into the political realm because which DFIs do you fund? Somebody will say, fund the land bank because we must agriculture. Somebody will say, fund the IDC because we want to industrialize. Somebody will say, fund the NHFC because we want housing. Somebody will say, go fund the DBSA because we want infrastructure. But hang on. There was a reason why these institutions were created. They were created to do precisely that. The IDC was created to fund industrialization. Don't ask the Reserve Bank to fund industrialization. The Development Bank was created to fund infrastructure. They must do that. Don't get the Reserve Bank into that space. This stuff of central banks being involved directly in the DFI space or getting involved in directed lending has been tried before with disastrous consequences. And the central banks reformed. Over a period of time, they evolved and started to focus on what they are good at. And in our case, the authors of our Constitution, and not just as they were writing the Constitution, at the time that we were going through the transition and we adopted constitutional principles against which the Constitution must be tested when it is finalized, included a constitutional principle that talked about the creation of a central bank whose task it is to protect the value of the currency. And when the Constitution was finalized, and many people say this thing, why doesn't the Reserve Bank play a role in growth? We do. The Constitution says what we do must be in the interest of balanced and sustainable growth. For growth cannot be balanced and sustainable in an environment where inflation is under control, out of control. For growth cannot be balanced and sustainable when you run imbalances in the economy, whether those imbalances are reflected in the external sector or are reflected domestically. Growth shall not be balanced and sustainable if the stance is such that you have got a build-up of financial risks in the economy which could result in financial instability. So the authors of our Constitution understood this, and in so creating the central bank, said that the central bank must be tasked with this responsibility. But the authors of our Constitution also did other things. They created the army to protect the territorial integrity of South Africa. You don't ask the army to go and shoot inflation, because that is not what they are designed to do. They created a judiciary whose job it is to administer justice and to interpret the laws of the country and the constitution of the country. Don't ask the judiciary to create employment. It is not their job, because if you ask the judiciary to create employment, they might just ask you to employ more judges. And I do not think that that is what we are actually looking at. So in a democracy, institutions are created for particular roles. Don't get one institution because it is successful at what it is doing, then overburden it with other responsibilities for which there are institutions in society that have been designed to deal with those challenges. So, you asked, Isaac, the stimulus package and what the role of the SARB is. Can you remove that man on the screen there, because I want to show something there. I want to project the laptop. You see, Isaac, this graph measures whether monetary policy is stimulatory or whether it is contractionary. And this is a calculation that is done. And what it tells us now is that where the real repo rate is, relative to where it should be, the repo rate is lower than what it should be, and that period, starting from the beginning of 2008, has been a period where monetary policy had continued to become expansionary and accommodative. So, long before anybody can talk about a stimulus package, the Reserve Bank was stimulating the economy. So that is our contribution. But why was it like that? It's because our mandate is to do the things we do, which is to promote stability in the interest of balanced and sustainable growth in the Republic. So I hope that that deals with that. Your comment on the weak rand and it not being competitive, I found it a little bit contradictory. Let's jog your memory and the memory of the others who are here. In 2009 and 2010, South Africans thought that there was a conspiracy driven by some people from somewhere to make our currency very strong and that it was killing our manufacturing. We forgot that. We said the rand was too strong, and for us to be competitive, the rand must be weaker. Be careful what you wish for. You might just get it. So now we got it. And now that we got it, we are complaining about the weakness of the rand. Either way, the approach of the Reserve Bank had been that we are pursuing a floating exchange rate. And in line with the policy of government, which was captured in some document that you might not like, which was published in 1996, that document said, we must have a competitive and stable, real, effective exchange rate. Taken to its full logical conclusion, it meant that you must have your inflation rate either in line or below that of the major trading partners, because that is how you enhance competitiveness. So you thought maybe we could buy back the dollars that had left. The point here is that when those dollars came in, they didn't come into the Reserve Bank. They were in the financial system. And so when they leave the financial system. That adjustment has had to take place. There are countries that tried to stop the money, not from leaving. They stopped it. They tried to stop it from coming in. So much so that they referred to it as currency wars. Just across the Atlantic. That narrative was in 2010. And bring it forward now, the narrative is we must try and stop this money from leaving. So you want to have a safety valve, and when there is pressure, you do not want the safety valve to play its role. That is where a floating exchange rate plays its role in that space. I hope I'm being clear. If I am not clear, I can always ask Mr. Minella to confuse me more. Msibi, you talked about the Reserve Bank focusing on past events rather than on being forward-looking. As we say in monetary policy, there is nothing we can do about the past. We can do something about the future. But it is difficult to figure out what the future is going to be. And in the process, you end up having to make forecasts which are based on assumptions, and you develop models to tell you what the future would approximately look like. But we can't have a world run by models and machines that tell us what the future is going to look like. Nothing replaces professional judgment. And that is why you have constituted the Monetary Policy Committee, whose job it is to make those judgments about, given our approximation of what the future looks like, the correct policy stance should be. And that is why we constantly say that our decisions on what the policy stance should be continues to be data dependent. So if a central bank looks backwards rather than forward, it creates a problem for itself. And the problem that you're creating is that inflation expectations will be backward-looking rather than forward-looking. And we always strive to get inflation expectations to be forward-looking, because a central bank should worry about future inflation rather than past inflation. Cartels and inflation and the competition board, I think that, Fundi, that looks like something you like dealing with, yes. I'll give that to Fundi. Balance of payments, crude versus refined, Rashad Kasim, you deal with that, and the intensification of manufacturing, if you could handle that. Naidu, in addition to VBS, I would like you to deal with the SARB and growth constraints and what you think could be done. Francois, inclusive growth, right? You like that stuff. If you could deal with that, because they say that we must deal with inclusive growth. Minale, I'm sure you might want to say something about this weak rent and the competition and buying back. I didn't understand the thing. It says that we must issue bonds and get back the dollars, but maybe you can explain those things better. So who shall we start with? Rashad.
Thank you, Governor. Well, I guess the question was, a bigger question about the balance of payments constraint, and whether we import oil, crude, and refine it, or whether we import equipment and so on. I just want to say that I think what's important is that there's always a balance of payments constraint, and that balance of payments constraint is a function of a number of things. So not surprisingly, many Asian countries have a current account surplus because they're highly competitive in a number of sectors, and it's the ability to be competitive that basically plays a very important role in determining the constraint. And that competitiveness is irrespective of whether you have mineral resources or not, irrespective of whether you've built your comparative advantage on the basis of skills and so on. So I think it kind of relates to the question on manufacturing, that at the end of the day, the important question that we have to ask is, why are we not competitive? What are the drivers of lack of competition? And there's a whole variety of things. It's about skills, it's about infrastructure, it's about technology and innovation. So I think the bigger question is, it's not the right question to say, why don't we refine more, or why don't we process our minerals more? I guess the question is, what is it that we think we can be competitive in? Some of it may not make sense, and others may make sense. So I think that it's a bigger question about really not so much to think about the balance of payments constraint, but to think about the comparative advantage. When our balance of current account deficit goes up because we have a lot of capital investment, that can be a good thing for a while, because we could use those capital investment to become more competitive, invest in industries, and then the constraints can go down later on. But it's obviously a very complex question about managing our ability to be competitive.
Fundi.
Thank you, Governor, for giving me a very difficult question. I think when one looks at what is going on with the economy, you refer to cartels, but you don't have cartels necessarily in all areas. So one has to understand the structure of the economy and what drives those, what drives the structure. So in some sectors you do have monopolies. So you have to understand why there is a monopoly in a particular sector. Do you have a monopoly because the service that is provided there is conducive to having one large supplier, in which case one would have to look at what is happening to prices. So in electricity, for example, we have a monopoly called Eskom, and that monopoly is regulated. So I think the issue is more coordination of different agencies of government. The governor referred to earlier to specific roles and mandates. So the one sector where we are active as the Reserve Bank is probably the financial sector, where we would be working directly with the competition authorities if there were things that needed to be looked at. But again, that would be very specific to the role that we play as a central bank. A lot of the analysis that one would have to look at is very microeconomic in nature. We as a central bank look at very high-level data. We make use of the information that's provided to us by competition authorities. So I don't think because you don't see the central bank working actively with the competition authorities, that doesn't mean we have an interest. We don't have an interest. It's just an area that we don't have necessarily the competence to look into. But we make use of the reports that are provided by the competition authorities to understand what is driving price formation in the economy, what is driving price formation in specific sectors. I think I'll leave it at that. Thank you.
Naidu?
Thank you, Chair. Governor, in one sense, you've answered the question about why the SARB shouldn't be given additional responsibilities to drive growth over and above the ones that we already have. But let me make sort of 3 points. The first is that price stability is a necessary condition for economic growth. It is not a sufficient condition, but it is a necessary condition. Without price stability, an economy can't grow rapidly and sustainably over a long period of time. And so the central bank is primarily tasked with achieving price stability because it is a necessary condition for longer-term growth. I challenge you to give me examples of countries with high inflation and high growth. There are lots of countries with high inflation and low growth. There are lots of countries with low inflation and high growth. I challenge you to give me a set of countries with high inflation and high growth. They're not there, and they're not sustainable. So our job as the central bank is to pursue price stability because it is a necessary condition for long-run growth. But we must also be honest enough to say that it is not a sufficient condition. Without price stability, you may not grow, but even with price stability, you may not get growth. You need other things. You need reforms that provide policy certainty. You need a skilled population. You need an infrastructure that works. You need a fiscal stance that is broadly developmental and predictable. You need sound tax policy. You need a myriad of things, human capital formation. You need good health care. All of those things contribute towards growth. And trying to task the central bank with all of those things will be a mistake. Right? I think it would damage the credibility of the central bank, and it won't give you growth in the long run. I like analogies, so I often come up with football analogies, but let me try a different one. Let's assume that we've got a tree, and this tree is not growing fast enough. Right? We, the bark of the tree, we protect the tree from fire, we protect the tree from moisture loss. But without water, without sunshine, without proper soil, that tree won't grow. You can't say, well, I want the tree to grow, so I'm going to strip the bark. Trying to give the central bank too much to do will be the equivalent of stripping the bark. It will be a disaster. Not only will you not get growth, but you reduce the likelihood of ever getting growth. So the central bank does play an important role in growth. We play that role because we've been given it in the Constitution. And these calls for the central bank to try and take on responsibility, it is not designed for, is not just bad economics or bad politics, but will damage the long-run sustainability of growth in South Africa. And we must be very careful not to fall into that trap. Do you want me to deal with VBS now or later?
Let me deal with this other question.
Governor, I know central banks aren't known for a sense of humor, but whilst my colleague DG Naidu was talking about stripping the tree of the bark, I couldn't help to think that that is like barking up the wrong tree. Getting to the question of inclusive growth, although I must admit I don't quite hear the question, what is it that you need to do to achieve inclusive growth? So let's take a step back. You need to promote economic growth, you need to create jobs, you need to empower citizens, and you need to mobilize investment so that you can support social change and bring about catalytic investment in physical and human capital. The issue is, what is our role as far as that is concerned? And I think both Fundi and Kuben has alluded to the fact that we are an enabler in that we create conditions that is conducive to economic growth. As Kuben has pointed out, when you have very high inflation, it is very difficult to achieve sustainable economic growth. Secondly, of course, in a way, very high inflation actually feeds into great inequality because, as we have on numerous occasions pointed out, inflation is far more erosive on the poor than on wealthy people that are better able to either hedge against inflationary pressures or to some extent are unaffected by inflation than what poor people are. So I think it's very, very important that we appreciate that if we create an economy whereby the central bank is known for its credibility, and that is why, despite the fact on some of those graphs you would have seen that we are close to Turkey and Argentina in some respects, despite the fact that we didn't hike interest rates, we didn't have a blowout of our currency because, in a way, the central bank enjoys credibility. So we didn't, for example, see an adverse negative market reaction after the September MPC, despite the fact that we left interest rates unchanged. And so these are some of the roles that we play. Similarly, if you look at the credit rating agencies, one of the issues they always highlight is that we have a strong independent central bank that follows orthodoxy in terms of how we execute monetary policy. And so our role is to create an enabling environment so that the economy can thrive, so that the market perception is that we pursue credible policies. Really, our job is limited in terms of the type of structural reforms that can be undertaken. Having said that, and that is often something that we say publicly, is that much of the downturn or slowdown in the economic growth are structural in nature. The central bank does have a role in terms of structural policy, and let me elaborate. We are a regulator. And so, for example, the structural reforms that were undertaken in terms of the redesign of the financial architecture of the global crisis is a form of structural reform that's undertaken. And what that does is hopefully bring about a more resilient financial sector. Another area that we are currently operating and which we do believe that is a form of structural reform and that could support economic growth and therefore inclusive growth is the stuff that we are doing in the fintech. Because what that has as an objective is not only to allow us to become better regulators in terms of that space, but we are also testing the technology for utilization in our own systems and processes, and hopefully contribute to a system whereby, for example, remittances or the transactional costs within the financial sector over time can be brought down. And those are small examples, but I do think it's important to make the point that we as a regulator does have some impact in terms of structural reform, but of course it is limited to a particular context. But generally we do not and cannot, and it would be beyond our legal remit to play any part in some of these activities that a number of people have suggested. We are a creature of statute, and therefore we are constrained by the four pillars of whatever legislative framework we operate within.
Thank you. Mr. Minana, did you understand that question?
I don't think, Governor, there's much I can add to what you've said without being inflationary, and Chris said it's not a good thing. But obviously, just to maybe, and I think both in your introductory remarks and in responding to the question, you've touched on all the points, and maybe just to underline the fact that, because I think you're relating it to, bonds being sold and all that, when non-residents were demanding dollars to repatriate any profits that or proceeds they might have gotten from selling South African bonds, those dollars were not supplied out of the central bank reserves, as the governor said. That was all transacted in the market, and from a point of view of our policy framework and our not targeting the exchange rate, I think the governor explained it very well, and we are also noting in the review, actually, that with flexible inflation targeting and the role that the exchange rate plays in that, the framework has actually worked in the way it was designed, and we make that point. But I don't think there's much more I can say.
Thank you very much. Kuben, we will come back to VBS. There are people in the overflow room. Ezekiel, are there questions there?
Is there any question?
Overflow room, are there questions?
No, Governor, no questions.
Okay, thank you very much, Kuben. VBS.
There were two questions. The one is whether any of the people who criticized us when we put VBS under curatorship has apologized. I don't know of anyone in particular who has apologized, but I can say that since the release of the forensic investigators report, there is a much greater public appreciation for why we acted. And I think that that's generally accepted now that we had to act. I think in some ways the forensic investigators report provided a good basis for why we acted and what went wrong. I haven't received a specific apology from anybody, but I think there is a broad general recognition in the public about exactly what happened and what went wrong. The second question you ask is about whether we should insist on joint auditors for all banks, not just big banks. Let me state that we do require the large banks to have joint audits because we think it's 4 pairs of eyes provides a greater oversight, greater quality assurance on the audit. And we like joint audits, and we insist on it for large institutions. For smaller institutions, it is slightly more complex because of the cost. Joint audits do push up the costs. It could push up the cost quite significantly, and you don't want to create a regulatory environment where you further raise barriers to entry into the financial system. You want to ensure that you can apply regulations at scale. So for smaller institutions, we require one auditor. But let me also state that there are at least 2 or 3 other things that we have to do to improve the quality assurance that we get from auditors. We require the audit committee to take particular attention on audit quality, and in the audit committee to give us a report on the independence of the auditor. We also, as the SARB, we approved the chair of the audit committee. We also approved the auditor and the audit partner. We don't get it right all the time, and I think that there's a broader problem in society in South Africa with the quality of auditors and the independent assurance that gives. I think from a country perspective, it is easier to fix the problem that we have in the auditing profession than it is to say that every company must have 2 auditors. Because soon you'll say 3 auditors or 4 auditors, and where do you stop? We actually have to, as a country, fix the industry, raise the bar on accountability in the industry, and make sure that we have independent checks and balances to verify the information that we get from auditors. We are doing that. We're taking particular attention to verify the information that we're getting from auditors. It's not always easy, but for the larger institutions, we certainly put a great amount of store into that. Thanks.
Okay, as we go back to the questions, before we get to more questions, between Pam and Sean, did you like my answer on the fiscal parameters in the model, or would you like to add something? No, before I get to the different question.
Okay, for now, Governor, I think that's fine, it's appropriate. We do use the core model to get some fiscal impacts, and then we use them into the QPM.
Okay, good. Elise.
Good evening, Governor. I want to go back to the MPC meeting of September. 3 of the members voted for a 25 basis point hike, and I wonder if those 3 individuals, if they are all present, could maybe share their thoughts on why they thought at that stage that it was a good idea to hike rates. In the light of the economy still in the recession and inflation forecast suggesting we're not really going to breach the 6% target level. So just an idea of the thoughts of the 3 members that wanted to hike. My second question relates to potential for second round effects on inflation flowing from either fuel price or rand depreciation. If the MPC members would start to spot a few signs of second round effects, do you want to see those signs sort of prevalent for a couple of consecutive months, or how would you handle that? If you see some second round effects in 1 month, will that indeed be some form of a trigger for rates? Thanks.
You will never know who the 3 members were, and you will not know who the 4 members were. So it will help you to just read the MPC statement, because that MPC statement was the MPC statement of all 7 members. So that is the rationale why rates were left the same. So that deals with that one, that's easy. There was a question here.
Good evening, Governor. My name is Governor Manganyi, and I'm an analyst. I wanted to ask, the Deputy Governor Francois touched on financial technology. So I've been very interested in trying to know how does the role of the central bank or central banking in general globally changes as we see these disruptions come into play, as far as monitoring the movement of currency between countries. And I also read a statement that was produced by the Bank of England around the difficulty of monitoring demand and supply of money. So what is the Reserve Bank doing on that, if there's anything that is being done? And also, are we seeing the role of central banking changing over time? Thank you.
Okay, that's Francois, that one has got you written all over it. Mr. Minele, you'll deal with the second round effects. Do you wait until the snake enters the house, or you see the snake is coming and you deal with it? There was another right next to Sean.
Hi, Governor. Kevin Pretorius from CAD Capital. You spoke about policy being accommodative. I'd just like to wonder if the Reserve Bank takes the following into consideration. Before the financial crisis, people borrowed at prime and prime minus rates. Now, it's a lot more difficult to borrow. In fact, it's probably prime plus 50 or plus 100, and that's not, and that's without probably the big deposit that you have to put down as well. So it's become a lot more difficult. So it's a bit more restrictive on that side. However, I'd also like to argue that from an investor side, rates are also much higher. Up until about 4 or 5 years ago, we had a JIBAR rate that used to match the repo rate. We now have a JIBAR rate that is 50 basis points higher than the repo rate. So from an investor side, you actually have a tighter policy or a higher policy rate as well. And in fact, if you just take a little bit extra duration, you could probably pick up as an investor an extra 100 basis points compared to what you used to be able to pick up sort of pre-financial crisis or up until about 5 years ago. So I'd just like to say, when you do say a policy is accommodative, do you take into consideration that borrowing costs and investment costs are now higher?
Okay. I'm going to leave the JIBAR repo thing with Mr. Minelo, of course. You're getting popular. And the prime minus before the crisis, bearing in mind that what we had before the crisis was not normal. So don't even think that as the situation normalizes, we will go back to what we were experiencing before the crisis. That's gone. It's not going to happen. But Mr. Minele will deal with that. Can you keep those hands up so that I do not forget you? Okay. There's one there in the middle, Ian, and at the back. That's the 3, and that is it from this room, and then I will probably go to the next room and close. Ian, oh no, sorry, sir, in the blue jacket.
Hi, Morendeni here from Alexander Forbes. I just wanted to find out, looking at the medium-term budget, do you think the rating agencies are actually excited at the moment, considering the fact that we're actually, pouring more money in the state, SOEs? And are you thinking about the spillover maybe on, weakening the rand?
Speak close to the microphone.
Pull the mic close to you.
Has it? Okay. Can you hear me now?
Yeah.
So are you actually thinking about the spillover effect in terms of the rand weakness, which could potentially happen if Moody actually changed the outlook to negative? Thank you.
Did you say that the spillover effects from the weakness of the rand, which will help? No, no, I've heard that part, the last part.
Let me just try to rephrase my question.
Just the last part where you talk about Moody's and the rand.
Are you thinking about any possibilities of Moody's changing,
Okay.
Yeah.
Okay, we got that one. Ian?
Thank you, Governor. Just looking at the huge enthusiasm that's developed around the probabilities of the success of Mr. Ramaphosa's $100 billion capital raising program, if there's any fair chance of achieving something like that, it would mean a whole new outlook on the growth potential of the economy. I haven't seen any estimates of that. Would you say that is perhaps then an indication of a lack of confidence? And perhaps it would be cynical to say that I see the target is put in dollars, but the actual attainment is always in rands. That it's not quite right, I think. And the other point is, if we say there is this optimism, but at the same stage, there's the JSE who published statistics on net foreign purchases or sales of South African bonds and equities, which running at about 70 to 80 billion negative for this year to date. That doesn't tie in with optimism on a new capital raising front. Could you comment on that, please?
Okay, right at the back.
Good evening, Governor. I'm Debo Mbanani from the Auditor General. I'm just curious about how the central bank works with government. We've been auditing the economic cluster for
full sort of evidence of second round impacts registering. You're almost too late because then by definition you'll be behind the curve. So it is a question of what our models that we work with suggest, how we overlay that with judgment, depending on how we assess the balance of risks. And of course, there's also no seamless way in which you can say now we're moving from initial price pressures to knock-on pressures. So it's very difficult to read, and that's partly requires an element of judgment, and where the science, the art and the science need to play together in terms of monetary policy. But in principle, you have to make sure that you don't react too early and potentially cause damage unnecessarily, but at the same time, you don't take undue risks by waiting too long. But where exactly those points are is not only easy to determine, and it's a probabilistic, it's a sort of risk management approach, if you wish. The second cluster of questions, I hope I got them right. The first one around where people borrow at with a prime and so on. We get that quite a lot with people sort of making reference to these spreads between the repo and prime. Let me start with that, and then I'll get to the JIBOR and repo spread. So the first one, the important point to make is that one needs to be careful not to use the repo rate as a proxy for the funding costs of banks. Yes, there is an element that, of course, they fund at repo, which we supply to them, but what actually determines their funding costs is informed by a whole host of other issues. It's got to do with, their liabilities, whether they're domestically funded, whether it's foreign. It's got to do with competition. It has to do with whether they're in a situation where they're currently trying to protect or win market share, which might, affect all of those kind of things that then translate into their lending rates, including, of course, most importantly, how they perceived the creditworthiness of customers that they're dealing with. So that one is an important point to make, in a sense that what gets referred to as the prime rate is really just a reference rate which helps with an element of transparency to make sure that people can compare from one bank to the next in terms of what is being charged. But what actually what the actual margin over and up or under might be, depending on conditions, is influenced by a whole host of issues that is important not to assume that, banks sort of have as their cost of funding the repo rate. The issue that you mentioned around sort of the JIBAR and repo spread, which I think at the moment is quite large. Typically, it's around 30, 35 basis points, and now it's around 50 as such. That is indeed a situation which has got quite a bit of imperfections in it in terms of the signaling that one would read from that, and we are actually currently involved with a large project to try and increase transparency and increase the credibility and the transparency of our interest rate benchmarks that gets used as reference rate for pricing sort of all manner of products in financial markets. So it is, we've just issued a consultation paper a couple of months ago, which is currently undergoing public comments. In the process, we are proposing to first and foremost reform the way in which JIBAR is calculated, but also in addition to that, adopt a multi-rate approach which will have, in the final consequence, a whole host of different types of rates that will be more sort of fit for purpose. And that will also, from a point of view of policy, allow us to read much better how we need to understand sort of financial conditions in the market. But that there are imperfections and we haven't got sufficient transparency in our money markets, that's a fair point.
Good. Mr. Groep.
So as an institution, first and foremost, we're a regulator, and so therefore we need to take cognizance of what's happening in the technology space, because as the technology gets adopted, both by the regulated entities but also by non-regulated entities, that could give rise to regulatory risk. So we try and monitor it. Now bear in mind, most of the time regulators play catch-up. What we have decided, though, is that the rate of change and of adoption is at such a rapid rate that we ourselves as regulators need to understand what is happening. Because it's not just fintech. People talk about fintech. It's cryptocurrencies or crypto tokens. It's artificial intelligence. It's machine learning. It's robotics. All of these things are developing and certainly being deployed within the financial services sector, etc. So what we said is that we want to monitor what's happening so that we're better able to judge some of the regulatory impacts of that and how it may influence, for example, supervision or guidance that we issue, etc. The second issue is that we, as an institution, are a consumer of technology. And so that's also important for us to monitor these developments. And so one of the things that few people appreciate, because it's probably not as much in the spotlight, is that we run one of the most important financial market infrastructure in the economy, namely the national payment system. And to give you an idea, it's a very small department, probably around 30 people, but we settle approximately, the value of the transactions in the past 12 months would have been in the vicinity of 150 trillion rand. Which is about 3 times the annual GDP of South Africa, or you could say around about every 12 days we settle within our system, the equivalent of the annual GDP of South Africa. And so one of the projects that was actually a global award-winning project was Project Corca, where we did a proof of concept utilizing distributed ledger technology in the real-time gross settlement environment, which is this SAMA system. And we will continue. We will probably announce in the next couple of weeks phase 2 of that in terms of once again testing certain proof of concepts. How will it, one of the big issues, of course, is cross-border flows, and that's something that we are concerned and worried about, I think, not only in South Africa. But it's not just the new technology, it's also new services. For example, some of these global players don't operate accounts in South Africa, and that is something that we do intend addressing very soon, where they're providing services in South Africa, but payment is to an offshore account. And these will be, for example, some of the issues where we will be tightening regulation, because it's not just about cross-border flows, it's the fact that it's erosion of our tax base in South Africa, because the taxes don't get paid, so there are obviously fiscal implications for those issues. But I think globally, it's not just something that's affecting South Africa, I think it's affecting multiple jurisdictions, and these are the type of areas where we need to tighten up, have better control, because it's not just the fact that funds are flowing out of the economy, it's obviously also implications for the illicit trade and illicit economy, and people using these channels sometimes to remit money for purposes that are not always legitimate. So there's an interest in wanting to monitor this. In terms of the role of central banks in the future, one of the big issues is that crypto assets would have profound implications for, first of all, the monetary policy transmission mechanism, but it could also have implications for the financing of commercial banks as we know it today. And so we are monitoring these developments quite closely, trying to understand, because it's not evident in which direction these things will be developing, because they will be very, very profound. But I don't want to preempt it. We intend putting out a position paper on this in the next couple of months, and also plan to have a workshop once we've published that to, for example, look into the implications of crypto tokens, both central bank issued crypto tokens as well as private issued crypto tokens. So that is what we are doing in this space. We're proactively working with local stakeholders, but also the international community, to understand some of these implications, because it gives rise to very, very significant and important economic questions, economic policy questions. So it's not just the technology, a lot of debate and focus on the technology, but there are very, very profound economic policy implications of these developments, and we're trying, along with our colleagues internationally, to understand these things better so that we can formulate informed policy positions on these developments.
Thank you very much. And the other questions that are left are fairly easy. MTBPS and how we think that the rating agencies will react. We will wait for their reaction, and then we will deal with their reaction at that particular time. We always engage with them, and I think that Moody's did release a credit opinion yesterday on Friday. So that's what we continue to monitor that. Ian, is this amount achievable? I do not know. But there is nothing wrong with being ambitious. And if the amount can be delivered, it will actually have a massive impact. What exactly the impact would be in terms of growth, it is a calculation that one hasn't done. I do not know. I guess this thing was announced in dollars because it was targeting foreigners, but the announcements of the investments were both foreigners and domestic investors. So if you want to know how we are doing in dollar terms, we will just have to use the exchange rate and work them backwards. Then it would look interesting. I don't. What did you say? We are Tebogo. Yes, Tebogo. The thing about creating the environment for investment and for growth, let's be honest, without naming other departments, that there were departments which made changes that impacted on the environment but didn't make the environment conducive. Let's just be honest. They did exactly the opposite. And in spite of any rational reasoning, they believed they are right. Don't ask me which departments. I am not playing in that space. Coordination of fiscal and monetary policy. Normally, this is the easiest part of any economic policy to coordinate. The most difficult part of economic policy to coordinate is microeconomic policy, structural reform, and so forth. And it is complex. It's like conducting an orchestra. And if in the orchestra there are people who are not playing their role and have not practiced the instruments they are supposed to play, the orchestra can produce a horrible sound. Right? That is microeconomics. Macroeconomic policy, which is fiscal and monetary, becomes easy to coordinate because there are only two institutions involved. Is the National Treasury, which is responsible for fiscal policy, and the Reserve Bank that is responsible for monetary policy. As part of the design in any democracy, you do not want one to dominate the other. And that is why one of them gets made independent with particular rules. So we, the Reserve Bank, had been given responsibility for monetary policy with a price stability mandate, which has to be measured and is being done through an inflation targeting framework. That is the monetary policy rule that we are actually using. On the fiscal side, to reinforce monetary policy, fiscal policy might also adopt particular rules. In South Africa, we had adopted the expenditure ceiling rule. The Minister of Finance had announced that that rule might not be enough and that we might want to complement it with additional rules. And I have got no doubt that if he really believes in it, he would go out and do it. The basic rule, as you heard the Minister of Finance saying in Parliament last week, the Reserve Bank is doing a good job containing inflation. So let us please not distract the Reserve Bank with discussions about its mandate and all of that stuff. Leave the Reserve Bank to do its job. And what did he say? He said, leave fiscal policy with me. I will sort it out. And that is the ground rules of engagement that lay the basis for a good coordination between fiscal and monetary policy. Ladies and gentlemen, thank you very much. That concludes the proceedings of tonight. Nimrod, you have got things to tell them.
Thank you, Governor. Ladies and gentlemen, you are cordially invited for a finger fork supper that is served at that has been served at the restaurant, which is located at the ground floor. And you are being requested to use the lifts. However, in the interest of healthy living, the bank has opened its staircase for our guests. And unlike in Virgin Active or Planet Fitness, you are welcome to use them for free. Wishing you a good night. Thank you for coming through.